Caption this: have you ever sat in a board meeting or an executive meeting where financial reports were being discussed? And then the financial reports were technically correct, but the room was still confused. So people in the room asked clarifying questions, one after the other, and at the end of it, decisions were deferred. And no one felt confident enough to move forward. So the meeting was inconsequential. Have you ever been in that scenario? I have been in one. And for me, that moment told me something very important, that accuracy is not always the same as usefulness. And this is why most non-profit financial reports fail executive decision making. So most finance teams believe their job is to produce correct numbers, which is true. They are expected to produce correct numbers. But on the other end, executive teams need something different. What they need is the context, the meaning, the priorities, and the early warning signals. So when reports fail to deliver that, leadership doesn't blame the system. They simply actually stop using the reports. And when executives stop using financial reports, then they start deciding based on instinct. And that is when risk quietly increases. From nearly 2 decades in nonprofit finance and reporting, working with executive teams, boards, donors, and auditors, I have seen the same pattern repeat itself across small organizations and even large, complex, global nonprofits. The reports weren't wrong, they were just misaligned with how leaders actually think. And that misalignment actually has a cost. So I went ahead and dived into what are some of these failures that make reports not executive or leadership friendly. So I have called this failure number 1, that you find that reports are built for compliance and not for decisions. So the first reason non-profit financial reports fail the executive decision mark is that the reports were designed for compliance and definitely not for leadership. So these reports, they are defined to answer questions like, did we spend money correctly? Are we within the donor restrictions? Do totals really concern? These are actually answers that the reports are expected to answer. So it is not wrong that when your report is designed to answer these questions, that your report is wrong. No, it's not wrong. It's just not enough. Because over and above, the executives are asking different questions. So over and above the 3 questions that naturally your financial reports are expected to respond to, your executives are adding more. And so what they are really asking you when they ask for your report is, are we on track? Where are we exposed? And what decisions do we need to take now? So when reports don't answer all these questions, they will get ignored. And you may wonder why your reports are compliant, are responding to donor requirements, but internally, you still find that there is that lack of trust in the reports that you give. Then the failure number 2 that I see is that sometimes as heads of finance, we give too much detail and too little insight. So many non-profit reports are overloaded with line items. You see budget codes, department codes, project splits, and all the parameters that make sense to us as the people in finance are the people who are consuming these reports in different areas. And it's also important to recognize the fact that different reports also fit different audiences. But the insight actually disappears under the weight of the detail, especially when you are giving executive level reports, because executives don't need to see everything. They only need to see what matters. So you end up finding that clarity can sometimes actually be subtraction and not necessarily addition. So if leadership has to search for the story in all the reports that you've given them, then the report has already failed. So failure number 3 that I see is that there are variances without meaning. Let's briefly talk about these variances. So you'll find that most reports, they actually show budget versus actuals, which is expected. I mean, program teams want to see their BVS, they want to see their progress, what resources they have spent and what they are remaining with to spend for the remainder of their implementation period. And also these budget versus actual reports also have percentages. They can actually show you this is already somehow in most cases calculated by the system. So it gives you the percentage, the burn rate or the percentage, and even the anticipated year-end burn rate, which is good, which is useful in different capacities. But sometimes they just stop there. They just give you the budget versus actuals and the percentage in the differences. Executives don't just want to know what changed. They want to know why it changed and what it means. So as a finance person, as a finance lead, as a finance director, a variance without explanation creates anxiety and not insight. And anxiety definitely slows decision making. And this is where I usually challenge my fellow finance leads that it is always important to understand the context within which you are reporting so that you are able to write the variance story, or you are able to collaborate with the programs team so that you are writing a variance story that you are presenting to the executives. That way, they are able to see what changed and why and what that actually means. So failure number 4 is that the reports arrive too late to matter. This is another silent failure, the failure of timing. So when financial reports arrive weeks after the period ends, they stop being decision tools and become historical documents. And in my very earlier version, episode 1 of this series, I talked about some of the constraints that are making it difficult for finance professionals to have timely month-end close or period-end close so that they can be able to curb this silent failure of timing in terms of reports. Because at that point, finance is reporting the past and not shaping the future. If you are going to be giving Q1 reports at the end of Q2, while activities and implementation and decisions that were required to be done before the quarter starts are gone, then you're actually just reporting about the past. And so that report is not helping the organization or the leadership to shape the future. So executives cannot influence outcomes they see too late. And the 5th failure is that there is no clear call to action in your report. And this is one of the most non-profits miss. Most non-profits miss, because great executive reports, they don't just inform. They answer what should leadership focus on, what decisions are required, or what risk needs escalation. So when a report has no call to action, So executives don't know what to do with it. Yes, it's a report, you sent it to them for your information, you wrote a summary, but it's not clear to them what it's answering in the 3 questions that I've outlined. What should they focus on? What decisions are required? And what risks needs to be escalated? So they move on. They write back and say noted, and they move on. And so an opportunity is definitely missed. So for me, the deeper issue is most non-profit financial reporting wasn't intentionally designed. They actually evolved in most cases. So when organization grows, that evolution also becomes a misalignment. And coming from this and learning from this in my work as I have continued, this is why a reporting clarity must be engineered and not just assumed. This exact pattern, compliant but unusable reporting, is what led me to develop the reporting clarity framework, a structured way to realign reports, leadership needs, and also decision circles. So finance moves from producing numbers to enabling leadership. So if your reports are accurate, but executives still hesitate to decide, the problem is not your accounting, it's your reporting design. So in the next episode, I will be breaking down what executive-ready financial reporting actually looks like and how to start moving towards it without overwhelming your team, because this is how clarity becomes influence. Thank you.